Welcome to our review of 2010 and our thoughts on what might happen in 2011. We had a good year last year, and I'm pleased to report to those who use our platforms. The aggressive and growth funds did particularly well with good double-figure gains. Our strategy of putting more of our equity bets into Asia and emerging markets bore fruit, with those markets outperforming the advanced markets in most cases. All markets made good progress in 2010 as the world economic recovery got underway. As we hoped, the world grew by a bit more than 4%, and the growth was particularly fast and furious in India, in China, and the emerging market economies that support them or are close to them. It was also quite a good period in much of Latin America. The bond market had a pretty quiet year overall, and the holdings we had in corporate bonds produced a return of around 6.5%, a little bit more than the income, as we'd hoped, and they provided a bit of ballast for the more cautious models. The last quarter was the most disappointing of the 4 quarters for those who held bonds, because in that period there was an understandable panic about government bonds where the yields were very low. We'd been avoiding government bonds for that very reason, allied to the panic over some signs of rising inflation throughout the world, and particularly the euro crisis. We held on in the main, getting the overall return for the year as a whole that we were expecting, because we felt that our high-quality corporate bonds should not be as badly damaged as the government bonds. They were, after all, yielding 5.5% to 6%, and companies are experiencing improving profits and cash flows in many cases. The exchange-traded funds we own in corporate bonds concentrate on the higher quality companies, which in the main are having good trading times and therefore should be able to pay the bond interest very well. So what are the prospects for 2011? Well, we think this is going to be another difficult year. It's going to remain a world where you've got the problems of success and fast growth in the emerging markets in India and China, inflation in food prices, inflation in general commodity prices, rising industrial costs, and we see going into the new year 2011 valiant efforts being undertaken by the leading emerging market country governments to control inflation, putting some restrictions on bank credit, sometimes raising interest rates. The other side of the world is still trying to fight its way out of the credit crunch and the recession that induced throughout most of the West. And we still see arguments going on about could there be deflation, could there be a double dip in the Western economies. We don't think that is a serious threat for 2011. We think they've done enough by having a very loose money policy and very low interest rates to keep their economies moving ahead. But you shouldn't expect fireworks and rapid growth in America or the main European economies. These are deeply damaged economies who are still having to fight their way out of the overextension of credit and borrowing in the private sector, which came to a head in the credit crunch. And now quite a lot of these countries also are going to have to fight themselves out of having borrowed too much at government level. We are saying to people, keep out of the main European countries for further investment in 2011, because we think the euro crisis will have another phase. We still like the emerging market economies, but we're watching them very carefully just in case they overdid putting on the brakes and slowing things down. And we are reducing our bond exposure a bit, because we think we've seen the best returns from those bonds over the last couple of years when they've given people good positive returns, returns above inflation. We're now entering a more inflationary period. We're entering a period when interest rates might go up around the world, and so we're cutting back a bit on the bonds.